Welcome to This Explainer. I'm jumping right in as your expert tutor today to help you absolutely nail Syllabus Area C3 of the ACCA FM exam, which is all about working capital strategies. We're going to break down the core principles from Chapter 13 so you can totally grasp how a business manages its short-term finance. If you've ever wondered how companies manage to not run out of cash while still maximizing their profits, well, you are in exactly the right place. Here is our roadmap for today. First, optimizing current asset investments, then permanent versus fluctuating assets, followed by the matching principle, and finally, evaluating funding strategies. Let's get right to it. Before we even look at a single formula, we've got to address the ultimate balancing act. How much cash does a business actually need to survive? Think about it. Hold too much cash, and your business is basically a glorified low-yield piggy bank, missing out on growth. But hold too little, and you're going to be in real trouble when your suppliers come knocking on the door. So this explainer is really all about finding that exact mathematical sweet spot.
Okay, Section 1, optimizing current asset investments.
So, your optimal investment level. It's driven by three primary levers. You can't just guess how much inventory to hold or how much cash to keep on hand. Financial managers are meticulously calculating this stuff based on trade terms, the length of their operating cycles, and how they stack up against industry benchmarks. Let's look at exactly how they do it.
First up, trade terms. Think of this as a massive financial tug-of-war. On one side, your suppliers want you to pay them yesterday. But on the other side, your customers want 30, 60, maybe even 90 days to pay you. You have to balance the credit you give versus the credit you get. Because if your customers are dragging their feet, but your suppliers are demanding cash up front, you're going to need a huge pile of cash just to bridge that gap. Then we have cycle lengths, or what we call the cash operating cycle. Just picture the journey of a single dollar. You use it to buy raw materials, it goes through manufacturing, sits in a warehouse as inventory, and eventually comes back as cash from a customer. The golden rule here is absolute. The longer that journey takes, the more working capital you've got to have tied up just to keep operations running smoothly. Which brings us to the third lever, industry benchmarks. These are essentially your reality check. I mean, if every other bakery in town holds, say, 3 days worth of flour, but you're hoarding 3 months worth, those benchmarks are loudly telling you that your assets are poorly optimized. Moving right along to Section 2, permanent versus fluctuating assets. To really grasp funding, we have to split our current assets into two distinct camps. On one side, we've got permanent current assets. That's the baseline liquidity you need to survive every single day. On the other side, fluctuating current assets, the temporary spikes you experience during busy seasons. Nailing this distinction is absolutely crucial for your exam because you end up financing these two categories entirely differently. Here is the key thing to remember about permanent current assets. They never actually drop to zero. Even on the slowest Tuesday of the year, you still need cash in the till, core inventory on the shelves, and you'll always have some outstanding receivables. They are the true bedrock of your operations. And because they're always there, they behave a lot like long-term fixed assets. Fluctuating assets, on the other hand, are like a toy store in November. Inventory just skyrockets right before the holiday rush to prep for December sales, and receivables spike right along with it. But come January, poof, those extra assets totally vanish. Because they rise sharply and then just disappear, they represent a purely short-term financing need. All right, Section 3, the matching principle. Now, this principle is a foundational rule you definitely need to know for your exam. It's essentially the Goldilocks ideal of finance. You want to perfectly align the lifespan of your funding with the lifespan of the asset itself. So, under the matching principle, you fund those permanent current assets we talked about with long-term finance, like equity or long-term loans. And you fund your seasonal, fluctuating assets with short-term finance, like a bank overdraft.
And that brings us to Section 4, evaluating funding strategies.
Of course, in the real world, not every company plays perfectly by the rules of the matching principle. We generally see 3 primary funding policies: aggressive, conservative, and matching. And as you can see mapped out here, cost, risk, and benefit are totally interlinked. You literally cannot get higher profitability without taking on higher risk. Let's break down how each of these actually plays out in practice. Let's start with the aggressive policy. This one relies heavily on cheaper, short-term finance. I'm talking about using it even to fund some of those permanent assets. Since short-term interest rates are usually lower, your costs stay low and your profits look amazing. But, and this is a massive but, the liquidity risk is huge.
If a credit crunch hits out of nowhere, like during the 2008 financial crisis, and your bank refuses to renew your short-term overdraft, your business could literally fold overnight. Then, on the total opposite end of the spectrum, we have the conservative policy. This is where a manager uses expensive long-term finance to fund all of their permanent assets, plus a huge chunk of their seasonal ones too. You are basically sacrificing profitability for total peace of mind. Yes, locking in long-term funding means carrying a much higher interest cost, but you gain this ironclad safety buffer against sudden freezes in the credit market.
And finally, the matching policy. This represents strict adherence to the theory we covered earlier. By perfectly syncing up the durations of your assets and liabilities, short-term with short-term, long-term with long-term, this policy generates moderate costs and moderate risks. It's really the textbook middle ground strategy for keeping a business stable while still staying competitive.
As we wrap up this explainer, I want to leave you with something to chew on. We've optimized investments, categorized our assets, and weighed the real-world risks of these different funding policies. Now I want you to put yourself in the shoes of a CFO. Based on the exact cost, risk, and benefit profiles we just went through, how would you balance the survival and profitability of your own business? Would you be aggressive, play it conservative, or look for that perfect match?